Greetings. In this particular lesson, we're going to take a look at monetary policy history after the 2009 period. Specifically, we're going to talk about the introduction of the interest rate on reserves policy that the Fed introduced and talk about how the Fed used interest rates on reserves to manage the federal funds rate. So this is a new tool effectively that the Fed is using, and it's a tool that did not exist prior to 2008. Prior to 2008, the Fed was not paying interest on reserves and was legally not allowed to do that. Remember, Congress created the Fed, and the Fed's practices, its mandate is dictated by Congress. So Congress has to give the Fed permission to do such things. And in fact, in 2008, Congress did give the Fed permission to pay interest on reserves. So, as we know, banks can hold their reserves in two basic ways. They can either hold vault cash, and banks don't hold a lot of vault cash because it's very costly to store, or banks can deposit funds in an account with the Fed. So the Fed is a banker's bank. Okay. But prior to 2008, the Fed did not have permission to pay interest on those reserves. So and banks used to complain about that because they felt that, particularly when they were required to hold some reserves with the Fed, there was a reserve requirement that they felt like the Fed was forcing them to hold reserves that they couldn't earn interest on, and therefore this policy actually hurt their earnings. All right. So let's go ahead and move on, and let's dive into this interest rate on reserves idea. The interest rate on reserves allows the Fed to move the federal funds rate in what we call an ample reserve environment. If you look at the history between 2009 and 2016, we come out of this financial crisis, this housing crisis in 2009, but the financial markets are still very weak and fragile, and there's been a loss of confidence, frankly. A lot of these mortgages were not repaid in that period, and banks really took a beating during that 2007-2009 period because, again, people weren't repaying loans, and depositors started to pull funds out of some banks because they were fearful that these banks would fail and they would lose these deposits. So the Fed's policy after 2009 was still very, very expansionary. And so what the Fed was doing between 2009 and 2016 was it was pumping more reserves into the banking system. And this practice did not stop after 2009. We talked about in the last video how the Fed aggressively was pumping reserves into the banking system during the crisis to basically provide liquidity to banks. So banks had reserves, and there were reserves to cover deposits, and banks had reserves with which they could make loans, good loans hopefully, and generate earnings. But between 2009, I'll come back to this picture in just a minute, but between 2009 and 2016, the Fed is still working with what it considers to be a fragile banking system. So notice that between 2009 and 2016, the Fed's assets, again, more than double. And we talked about this in the last video, where between 2007 and 2009, the Fed's assets doubled from less than $1 trillion to more than $2 trillion. And then again, between 2009 and 2016, now this is a 7-year period, not a 2-year period, but between 2009 and 2016, these assets double again. So the Fed's balance sheet has become historically large during this time period, and to this day is at historically high levels. Okay, so let's go back up to this picture and take a look. Let me see if I can get rid of this. There we go. So what happens between 2009 and 2016 is reserves just become more and more ample. All right. The point is, let me get my the point is, we'll just make a little note over here, that we see a more ample, let me see if I can write this. We see a more ample reserves environment. So it's not like the Fed has reversed its policies. It's not like the Fed has worked aggressively to move the supply curve back to the left to sell off all these assets. Not the case. Actually, the Fed has doubled down on its expansionary monetary policy and has moved things into a permanent new world. And this new world is called ample reserves. Now again, notice this supply curve is intersecting way out here. Intersecting what? Intersecting the demand curve. The demand curve is running at, the demand curve is basically running along this zero, this axis, this horizontal axis at zero. And so the supply curve is meeting the demand curve way out here, and the federal funds rate is zero. Okay, so we're back to a zero interest rate policy. Or I should say we're maintaining a zero interest rate policy between 2009 and 2016. So what's interesting here is the Fed has only pushed the supply curve farther to the right, which means there's no going back now. There's no going back. The Fed would find it almost impossible to move the supply curve back to the left to a point where it would be on this upward sloping portion of the demand curve. So now the Fed's finding that open market operations cannot move the federal funds rate. And this was a point I made in the last video, and I want to make it again, that in an ample reserves system, this is really the principle you need to pull from this, in an ample reserve system where the supply curve is hitting the demand curve at 0%, the Fed cannot control the federal funds rate using open market operations. Just cannot move that rate. So the Fed needs to use another tool, and that tool will turn out to be the interest on reserves, and I'll talk about that in a minute. Now, this period again, as I said, is characterized by zero interest rate policy. If you go back and look at interest rates between 2009 and 2016, which I've done in preparing these materials, you'll see that bond yields were very, very low, historically low. And so pre-COVID, which would be in this pre-COVID period, we'll talk more about the pre-COVID period in a minute, we have very, very low interest rates. Our prime rate is very low, and consumer debt rates are credit card interest rates are very low. Now, what's interesting is pre-COVID, the Fed starts to feel like it needs to raise the federal funds rate a little bit to a more normal level. A federal funds rate of zero is an abnormally low level historically for the federal funds rate. And this again is that a zero interest rate policy we talked about in the last video, that the Fed decided to push the federal funds rate down to zero, and then the prime rate drops to around 3% and sits there, and credit card money drops down to about 7% and sits there, and interest rates compared to historical levels are very, very low. But the problem with this is this punishes savers. This punishes savers. It certainly benefits borrowers. Borrowers love it. Low interest rates make it easy to borrow and buy. But low interest rates really punish savers and encourage savers to push their funds into riskier assets, for instance, stocks. So if you can only earn a return of 1%, say you have $500,000 in a certificate account, a certificate of deposit account, and that's only paying 1%, that interest rate is ridiculously low. And if you're trying to build for retirement or trying to save to buy something, you want to earn better interest in that. So a lot of people were moving their funds out of safe deposit accounts that were paying low interest rates, and they wanted to move those funds into the stock market where they could earn higher returns. But the problem with moving funds into the stock market is the stock market is very, very risky. It's much more volatile. And so the Fed decided that for this 2016-2019 period, now again, we're pre-COVID. We haven't gotten to COVID yet, and we'll talk about that in a minute. But between 2016 and 2019, the Fed wants to raise wants to raise the federal funds rate. Now it's very interesting. In 2016 to 2019, the Fed doesn't dramatically increase its balance sheet. It keeps its balance sheet constant at about $4 trillion. So it's not engaging in further expansionary monetary policy using open market operations. So the Fed's not using open market operations now. It's got ample reserves in the banking system, as we pointed out. The Fed needs another tool, and what it's going to do is it's going to use the IOR rate to move the federal funds rate. And this tool ends up becoming an important way that the Fed can actually raise and lower the federal funds rate without manipulating the level of reserves in the banking system. So let me show you how this works. And this is very important. This is one of the most important points in this video, that if the Fed wants to raise in an ample reserves environment, okay, if the Fed wants to raise the FFR, say from 0% to 2%, it has to use the IOR rate to do that. And that's exactly what it did. If you take a look at the data and the economic history back there, the Fed actually raised the federal funds rate up into the 2% range. It bobbed up around the 2% range. And the way it did that is it raised the IOR rate. Now you go, why would this work? How does this work? So if the Fed puts a 2%, if the Fed says, okay, we're going to begin to pay 2% on any deposits banks make with the Fed. So we're going to say, if you deposit with the Fed, we'll pay you 2%. So that encourages banks, listen to this, now this is how it works. This encourages banks to not loan funds to each other in the federal funds rate, in the federal funds market. It encourages banks to stuff their money into these interest-paying reserve accounts with the Fed. So what happens to the supply of reserves in the federal funds market? Here's the federal funds market. It decreases the supply of reserves in the federal funds market. So banks don't want to offer loans to each other anymore. They want to park their funds. They want to park their funds with the Fed and earn 2%. Now what does that do? That decreases the supply of reserves offered in the federal funds market. So this is the key idea. The supply of reserves being offered in the federal funds market decreases. Now this doesn't alter the total amount of reserves. The total amount of reserves in the banking system is determined by open market operations. And let's say that's around $4 trillion at the beginning of this period. But it's how those reserves are being used. Are they being loaned to are banks loaning them to each other, or are banks simply parking them in an account with the Fed? That's the question. And if you raise the IOR rate, that encourages banks to park their funds with the Fed in these Fed accounts and not loan them to each other. Well, that decreases the supply of federal funds, and guess what? It drives the federal funds rate up. This is simple supply and demand. If you pull funds out of the federal funds market, decrease the supply of those funds, it will drive up the price of those funds, which is the federal funds rate. So the IOR rate, the interest on reserves rate that the Fed pays for people to put their funds in a Fed account, it really sets a floor on the FFR. In other words, if the Fed raises the IOR, the federal funds rate is going to follow. It's going to go up. And actually, you're going to learn that if the Fed lowers the IOR, it works in reverse. The federal funds rate will drop. So the IOR, this IOR rate, becomes a key monetary policy tool, because now the Fed can very directly influence interest rates by moving this IOR rate up and down. This essentially becomes what we call an administrative rate. Administrative rate. And the idea here is, before this, the Fed could manipulate the federal funds rate, but not really directly control it. But now with this IOR rate, the Fed can directly control the federal funds rate. And this gives the Fed a very, very, very powerful tool for moving that federal funds rate in the short run. Okay? Now, all of this is in your e-workbook, and I strongly encourage you to read this as well. Not just watch the video, but watching the video should make it easier for you to read this material when you go to read it. Okay? And there's material in the e-workbook that is not in this video. I mean, there's not a lot of it, but there are some things that I expect you to learn that I can't put on video. I can't put everything on video. Okay, I'm putting the high points and the hard points on video. Now, let's keep going here. COVID. See, I'm kind of walking you through history here, some history, and I'm showing you what the Fed has done and some of the innovations the Fed has applied or implemented to deal with these issues that the Fed was facing in the 2020s and before. So prior to COVID, which hit the world in the United States in 2020, we have the financial crisis of 2007, 2009, and then we have a relatively quiet period between 2009 and 2020, okay? But in 2020, COVID hits, and again, we were facing a major recession and even talks of a depression, given the way economic activity is collapsing and how quickly it's collapsing. So what does the Fed do in 2020? It returns to a zero interest rate policy, okay? And that's easy to do because now what the Fed has already pumped in huge amounts of reserves into the banking system. So there's no lack of reserves in the banking system. But the Fed now wants to lower that federal fund rate from 2% back to zero. Okay? So what does it do? It lowers the IOR rate. By lowering the IRO rate, it's able to pull the federal funds rate back down to zero. And you say, how? How could it do that? Well, let's talk about it. Let's talk about it. When the Fed lowers the IOR rate, it causes banks to move reserves out of accounts with the Fed. So if the IOR rate drops below the federal funds rate, what are banks going to do? They're not going to be as interested in leaving funds in these accounts. They're going to want to loan these funds to each other. So banks are always interested in the highest interest rate they can get and the safest interest rate they can get. The IOR rate and the federal funds rate are very safe loans. Okay, they're going to get repaid. Okay, so if you park funds in an account with the Fed's definitely going to pay you interest and give you those funds back. If you loan money to another bank in the banking system, those banks are going to repay you. Banks honor loans made to other banks. Okay, the last thing in the world you don't want to do is don't want to renege on a loan that is from another bank. So when the IOR rate is lowered, banks are going to say, man, we can't make as much interest by leaving it on deposit with the Fed. Let's move some of those funds out and begin to loan it to other banks. Well, what that's going to do is increase the supply of funds in the federal funds market. So banks are going to find it more attractive to loan to each other rather than to park those funds in this federal funds, Federal Reserve account. Well, the effect of increasing the supply of funds in the federal fund market causes the FFR, the federal funds rate, to move back towards zero. And that's exactly what happened during COVID. The federal funds rate fell again back down to zero. Guess what? We're back to zero interest rate again. Zero interest rate, zip policy. Zero interest rate policy again. The federal funds rate fell back down to zero during COVID. Now that doesn't mean all interest rates were zero. Again, it's federal funds rate plus 3 equals prime, plus 4 equals credit card money. But the Fed was again trying to lower interest rates during this health crisis to keep spending relatively strong, to encourage households as much as they could to spend, and to encourage businesses to continue with their investment plans. And that, of course, was designed to boost GDP. or to keep GDP at least from not falling as far as it would have fallen. Okay, the idea is to soften the recession. It looks like due to COVID, we're moving into a severe recession. What can we do to soften that recession and prevent the big D word, which is called depression? So between 2019 and 2020, the Fed's assets again increased. During COVID, the Fed dramatically increased its assets again from roughly $4 trillion to $6.5 trillion. So now the Fed's assets are at record high levels, again, just hitting these new, and of course the supply curve for reserves is shifting even farther out to the right. So government bond rates are very, very low. They're actually at historical lows during COVID, and they remained at historical lows during COVID. And short-term interest rates, a la the federal funds rate, the prime rate, and credit card money, those interest rates are all very low as well to try to stimulate the economy during COVID. Now, I'm going to end the video here again, so we keep these videos relatively short. But my last video in this particular series is going to have to do with the post-COVID period, and I'll show you now where the federal funds market is and prospects for the future. I hope you've enjoyed this video. Even if you haven't enjoyed it, I hope it's been helpful, and take care.